Ever wondered how Warren Buffett became one of the most successful investors of all time? It's a question that many have pondered, and the answer lies in his unique approach to investing. Warren Buffett, often referred to as the Oracle of Omaha, is a name synonymous with success in the investment world. His journey began in Nebraska and has led him to become the chairman and CEO of Berkshire Hathaway, a multinational conglomerate holding company. Buffett's net worth is in the billions, making him one of the wealthiest individuals on the planet. So what's the secret to his success? Buffett's investment strategy is surprisingly simple and grounded. He follows the principles of value investing, a strategy that involves buying stocks that appear to be trading for less than their intrinsic or book value. In other words, he's on the lookout for bargains, companies that are undervalued by the market but have strong fundamentals. But it's not just about finding cheap stocks. Buffett is known for his long-term investment approach. He doesn't jump on short-term trends or get swept up in market hysteria. Instead, he invests in companies he believes in, with solid business models and strong management teams, and he sticks with them for the long haul. This strategy is quite different from many others out there. For instance, active investing involves frequent buying and selling in an attempt to outperform the market. Then there's growth investing, where the focus is on companies that are expected to grow at an above-average rate compared to other companies in the market. Buffett's strategy also contrasts with top-down investing, which starts with an analysis of the macroeconomy and then drills down to the sector and company analysis. His approach is more of a bottom-up style, focusing on individual companies rather than the overall market or specific sectors. It's important to note that Buffett's strategy isn't for everyone. It requires a lot of patience, discipline, and a keen understanding of businesses. But it has certainly served him well. Now that you know a little about Warren Buffett, let's dive into the different investment strategies and styles. So, what are the different investment strategies that you can use? Let's dive right in. First up, we have passive versus active investing. Passive investing is like setting your financial cruise control. You invest in a broad market index fund and let it ride. The goal here is to match the market's performance, not to beat it. It's simple, cost-effective, and takes less time. However, it doesn't offer the potential for outsized gains that active investing does. Active investing, on the other hand, is a hands-on approach. It involves picking individual stocks or sectors to try and outperform the market. It can yield higher returns, but it also comes with more risk and requires more time and knowledge. Next, we have growth versus value investing. Growth investing is about buying stocks of companies expected to grow at an above-average rate. It's exciting and offers high return potential, but it can be risky if the growth doesn't materialize. Value investing, like Warren Buffett himself practices, involves buying stocks that appear to be undervalued by the market. It's like hunting for bargains in the stock market. The upsides are high if you pick right, but it requires a thorough analysis and patience. Then there's income versus capital appreciation. Income investing focuses on securities that regularly generate income, like dividends. It offers a steady stream of income, but the growth potential may be limited. Capital appreciation, on the other hand, involves investing in stocks that may not pay dividends but have the potential to increase in price over time. The payoff can be substantial, but it's also more volatile. Lastly, we have top-down versus bottom-up investing. Top-down investors start by looking at the overall economy and then find the best industries and companies within those industries. It's a big-picture approach, but it can overlook good companies in bad industries. Bottom-up investors focus on the fundamentals of individual companies regardless of the industry or economy. It can uncover hidden gems, but it also requires a lot of research and analysis. With these strategies in mind, let's move on to investment styles. Investment styles are as important as strategies, but what are they? Well, let's dive in. To start, we have value investing. This style, famously used by Warren Buffett himself, involves hunting for stocks that are undervalued. In other words, you're searching for stocks that you believe the market has priced too low. The upside, the potential for significant returns if the market corrects the price. The downside, it requires a lot of research and the market may not correct the price, leaving you with a low-performing investment. Next up is growth investing. This style involves investing in companies that display signs of above-average growth, even if the share price appears expensive in terms of metrics such as price to earnings or book value ratio. The potential advantage here is rapid capital appreciation. The risk? These companies may not live up to their high growth expectations, leading to substantial losses. Then we have income investing. This style is all about buying securities that pay out regular income. This could be in the form of dividends from stocks, interest from bonds, or rent from real estate. It's a great way to generate a steady cash flow. However, it may not offer as much capital growth. Finally, there's market-neutral investing. This style involves taking a balanced approach between buying and short selling in an attempt to have zero market exposure. The goal is to make a profit regardless of whether the market goes up or down. It sounds great, right? But the catch is, it can be complex and requires a high level of skill and understanding of the markets. So, there you have it. 4 distinct investment styles: value, growth, income, and market neutral. Each comes with its own set of potential rewards and risks. It's crucial to remember that no one style is inherently better than the others. It all depends on your individual goals, risk tolerance, and investment horizon. Now that you understand investment styles, let's talk about how to choose the right one for you. Choosing the right investment strategy and style can be challenging, but it's crucial for your investing success. The world of investing is broad and full of variety, and understanding what suits you best is key to long-term prosperity. Let's start by identifying your goals. Are you investing for retirement, to buy a house, or perhaps to start a business? Your investment strategy should align with these goals. For instance, if you're saving for retirement, you might look towards long-term strategies like buy and hold, focusing on stable growth over time. Next, consider your risk tolerance. All investments carry some level of risk, but some are riskier than others. If the thought of losing money keeps you up at night, you might lean towards a conservative strategy such as income investing, which focuses on steady returns from dividends or interest. On the other hand, if you're comfortable with riskier ventures, growth investing, which aims for capital appreciation, could be your game. Your personality also plays a big part. Are you patient, or do you crave immediate results? If you're the former, you might thrive with a passive investment strategy, buying and holding for the long term. If you're the latter, an active strategy where you frequently buy and sell securities based on market trends might suit you better. Your time horizon is another factor to consider. If you're young and have plenty of time before you need to cash in on your investments, you might be able to afford a more aggressive strategy like growth investing. If you're closer to retirement, a more conservative approach like income investing might be more appropriate. Lastly, remember that no single strategy or style is the best. The most successful investors, including Warren Buffett himself, often employ a mix of strategies and styles, adapting as market conditions and personal circumstances change. Choosing the right investment strategy and style isn't a one-time decision. It's a process that evolves as you grow and learn. So be open to trying different approaches, learning from your experiences, and adjusting your strategy as needed. Now you're ready to invest like Warren Buffett. Remember, the journey of investing is a marathon, not a sprint. Patience, persistence, and a sound strategy are your keys to success. Happy investing! We've covered a lot today, from understanding different investment strategies and styles to choosing the right one for you. We've delved into the investment world, dissected the techniques of the legendary Warren Buffett, and analyzed various methods like passive and active investing, growth versus value, income versus capital appreciation, and top-down versus bottom-up approaches. We've discussed the importance of aligning your investment strategy with your personality and financial goals. We've highlighted that there's no one-size-fits-all strategy, and that the best approach is the one that fits you like a glove. Just like Buffett's value investing strategy fits his patient and disciplined demeanor. Remember, passive investing is for those who prefer a hands-off approach, trusting in the long-term growth of the market. Active investing, on the other hand, is for those who seek to outperform the market through strategic buying and selling. We've also compared growth and value investing, emphasizing how growth investors chase companies with high potential, while value investors like Buffett hunt for undervalued stocks with strong fundamentals. We've also explored the difference between seeking regular income through dividends or interest versus aiming for capital appreciation, which is the increase in the value of an asset. Lastly, we've contrasted top-down and bottom-up investing, where the former starts with global economic trends and the latter begins with individual company analysis. We've unraveled the complexity of investment strategies and styles, giving you the tools to navigate the financial markets with confidence and foresight. But remember, investing is a journey, not a destination. It requires continuous learning, patience, and resilience. So keep these lessons close to your heart as you embark on your investment journey, whether you're just starting or are a seasoned investor looking for a fresh perspective. Remember, the key is to invest like Warren Buffett, with knowledge, patience, and a keen eye for value. Thank you for watching. If you found this video helpful, don't forget to like, share, and subscribe, and let us know your investment experiences in the comments below. Happy investing.